Money is not paper. Money is not numbers. Money is control. Long before screens and servers, power was built in silence. Not by soldiers, not by kings, but by records, by debt, by promises written in stone. Banks did not follow empires. Empires followed banks. This is not motivation. This is not opinion. This is history. And history shows one truth. Those who controlled money controlled everything. More than 5,000 years ago in ancient Mesopotamia, organized finance emerged. Temples and palaces stored grain and silver. Deposits were recorded on clay tablets. Loans were issued to farmers and merchants. Interest was charged. Debt was enforceable. These institutions functioned as the first banks in recorded history. In Babylon, around 1800 BCE, financial activity was codified into law. The Code of Hammurabi defined interest rates, loan terms, collateral rules, and penalties for default. Credit became regulated. Money became institutional power. In ancient Egypt, the state controlled wealth through centralized storage. Grain was collected, stored, and redistributed through government granaries. Receipts represented value. Transfers replaced barter. Accounting became a tool of authority. In ancient Greece, banking expanded with trade. Private bankers known as trapezotai exchanged currencies, accepted deposits, and financed commercial voyages. Greek city-states depended on maritime trade. Finance enabled expansion beyond borders. In ancient Rome, banking became integrated into daily life. Argentarii managed deposits, loans, and payments. Financial contracts were protected by Roman law. Courts enforced debt obligations. Banking supported infrastructure, military logistics, and imperial administration. When the Roman Empire declined, banking systems collapsed. Coinage weakened. Trade contracted. Wealth concentrated in land ownership. Financial networks disappeared with political order. From the 8th to the 13th century, finance re-emerged through Islamic trade networks. Merchants developed written payment instruments known as SAC. Partnerships pooled capital. Risk was shared. Accounting practices advanced. Capital moved across regions without physical transfer of gold. Medieval Europe revived finance through commerce. Italian city-states became financial hubs. Florence, Venice, and Genoa financed trade, governments, and wars. Merchant banks expanded across borders. In the 14th century, double-entry bookkeeping was formalized. Every transaction required balance. Financial accuracy became systematic. Errors became visible. Control became precise. The Medici Bank, founded in 1397, operated branches across Europe. Letters of credit reduced transport risk. Currency exchange generated profit. Banking families gained political influence through financial leverage. During the Age of Exploration, global trade expanded. Precious metals from the Americas entered Europe. Money supply increased rapidly. Prices rose. Inflation reshaped economies. Capital markets adapted to scale. In 1602, the Dutch East India Company issued publicly traded shares. Ownership was divided. Risk was distributed. Investors funded overseas trade without direct involvement. The Joint Stock Corporation was established. The Amsterdam Stock Exchange became the first organized securities market. Shares were traded regularly. Prices reflected expectation and information. Finance became forward-looking. In 1694, the Bank of England was founded. It financed government debt in exchange for authority to issue banknotes. Public credit stabilized state finance. Central banking began. Paper money expanded across Europe. Banks transformed deposits into loans. Credit multiplied economic activity. Trust replaced metal. In the 18th century, insurance markets developed. Lloyd of London insured ships and cargo. Risk became calculable. Loss became transferable. Commerce expanded further. The Industrial Revolution transformed finance. Factories required large capital investment. Railways demanded long-term funding. Joint stock companies expanded. Banks mobilized savings into industry. In the 19th century, national banking systems formed. Central banks regulated currency issuance and reserves. Gold standards linked money to metal. Exchange rates stabilized international trade. Investment banks underwrote bonds and equities. Governments and corporations raised capital at scale. Infrastructure expanded. Markets integrated globally. In the United States, the first Bank of the United States was established in 1791 to stabilize credit and currency. Political opposition led to its closure. Financial instability followed. The Second Bank of the United States was founded in 1816 to regulate state banks. Its dissolution in 1836 led to credit expansion and banking crises. History recorded the cost of unstable finance. By the late 19th century, London dominated global finance. Capital flowed through banks, exchanges, and insurers. Financial centers shaped global trade. In 1913, the Federal Reserve System was created. Monetary authority was centralized. The lender of last resort function was formalized. Modern central banking took shape. In the early 20th century, financial markets interconnected globally. Leverage increased. Speculation expanded. Capital moved faster than regulation. In 1929, stock markets collapsed. Banks failed. Credit froze. The Great Depression followed. Governments restructured financial systems. Banking regulation increased. Deposit insurance was introduced. Throughout history, finance determined scale. Banks funded states. Investment built industries. Credit moved civilizations. Money followed structure. Structure created stability. Stability enabled expansion. No empire rose without finance. No system survived without credit. No power existed without capital. This is not motivation. This is historical record. Money was engineered through law, through accounting, through risk, through trust. Those who understood finance shaped nations. Those who controlled credit controlled movement. History proves one rule. Money is never neutral. Money is never passive. Money builds power.